have to ask you about the turmoil in the public markets. We were seeing there the S&P down, the tech-heavy NASDAQ down almost 6% just in the last 3 days. How justified is that? First
of all, thank you very much for being at our Global Investment Research Tech and Internet Conference. We've got almost 2,000 people here registered. So we're having a great conference, great turnout. So I appreciate you being here and highlighting the event. So look, the public markets clearly will have an impact on the private companies. You know, when you take a company public, you look at the comparables that exist in the market today. And that's the first benchmark for valuing any new offering, is to look at the similar companies and take your valuation benchmark or metric from what exists out there. So everyone is watching what's going on in the public markets today.
So LinkedIn, for example, I know they had a weak forecast, but is it really worth half of what it was last week?
No one can say for sure that it's worth half of what it was, or it was worth what it was the week before. What investors are trying to tell you today is that cash flow and earnings matter. The market is now maturing for internet and technology companies. In a more mature industry, you start thinking about earnings, revenue, cash flow, not nearly as much about growth. Historically, the technology companies have been valued on growth, and you put big growth multiples on these companies. As we're shifting from a growth multiple to an earnings multiple and a cash flow multiple, we're coming up with different valuations. Yes, it can be shocking to revalue a company from a growth multiple to a earnings or cash flow multiple, but it's happening, and it's a natural evolution. Normally we see it evolve over a longer period of time. For some reason, or for a variety of different reasons, we're seeing it happen relatively quickly in some of these technology companies.
So are we seeing a massive revaluation of tech? Is that what we're in for this year?
You're definitely seeing a revaluation. In some companies, you're seeing a massive revaluation. That's not saying that we can't go back up to the old valuations, but the market is clearly taking a pause and trying to understand the long-term viability and the long-term wealth creation vehicle for shareholders.
Your boss said earlier today that you're seeing pent-up IPO demand because private funding is drying up. Are companies really thinking about going public in a market as volatile as this?
Well, look, the premise in many of these technology companies for years has been growth, 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 and we will be able to get funding no matter what as long as we're growing. We'll use this funding to grow, which will allow us to get the next round of funding, which will allow us to grow. If you can't get funding, it changes the premise to some extent. You now have to think about changing your model from just pure growth to creating cash flow, to creating revenue, creating return on capital. If you can create cash flow return on capital, you will have access to the public market, and buyers and investors will show up at that point. Historically, companies have not wanted to go into the public markets because the public markets will, at some point, like we're seeing now, they will demand earnings power. They will demand some return on capital. They will demand that you actually create revenue, that you just don't grow your company forever.
So what happens then to IPO volume in 2016? What happens to M&A? How does 2016 compare to 2015?
Well, so if companies choose to or are forced to go public, we will see a pickup in the amount of IPOs. But if they're forced to go public, the question is, will the market allow them to go public? Only companies with a robust, long duration business model will be able to access the public markets. The public markets have become very discerning. In January, we did not have an IPO.
Exactly.
We didn't have an IPO because the flow of funds into the public markets were not there. You know, to do an IPO, you need new investors. You need capital to be coming in the market. If you're an asset allocator today, or you're running a mutual fund, or you're a big investor, you're probably pretty fully invested today. If I bring you a new IPO, for you to be able to buy that IPO, you need one of two things to happen. You have to sell a position you already own and think that the IPO is a more favorable rate of return than something you own, or what's in a better outcome is you need to be getting positive inflows in every day, and you have to put those to work, and the IPO is a great place to put them to work. We haven't been seeing positive inflows in the market. In fact, we've been seeing outflows from the market. So until we get inflows in the market, or we get a change in valuation of the IPOs, it's going to be somewhat difficult for some of these companies to go public. That said, we think we will get a normalization of valuations. We think that many of these companies will be able to go public as the markets continue to settle down, or when the markets settle down.